Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. We begin with our top story, the growth rotation, taking a breather, going into Microsoft earnings after the closing bell. Bob Doll of Crossmark writing this: small caps typically outperform in the early stages of economic expansions. We caution against chasing these gains at such a late stage of the cycle, even though cheap valuations may offer some cushion. Bob joins us now for more. Bob, wonderful to catch up with you, buddy, as always. Let's look ahead to the earnings later. Microsoft kicks it all off for the Max 7 numbers that report this week. What are you looking for? And how do you gauge what investors are willing to reward and what they seemed like they want to punish over the last few weeks?
I think the bar is high for these companies, Jonathan, and they're going to have to make those numbers more likely exceed them for the stocks to be okay. People are looking for excuses to trim these names, and they just reported. I own some of that. Let me trim it. I think that's the general trend in these names. Expectations high.
Dan Ives of Wedbush with even bigger expectations. He's looking for an even bigger rally in big tech. We believe this week and the rest of 2Q earnings will be a major positive catalyst for the tech sector. We expect tech stocks to be up another 15 to 20% for the year, adding to the robust tech gains in the first half of 24. Bob, what would deliver 15 to 20% upside for tech stocks? Where's that going to come from?
Therein lies the debate. That we're going to have a further leg in AI. We're going to have exceeding earnings expectations, earnings estimates moving up, in my view, to get another 15 to 20%. People own these stocks. It's not like they're undiscovered. So to buy more of them, we're going to need better news that it's hard for you and me to anticipate.
We should talk about the flip side of that, which is how much more downside could there potentially be in the tech sector. John was talking about Bank of America research saying time to show monetization. Since the first quarter, there is $9 expended in CapEx revision for every $1 in additional sales of hyperscalers. In other words, we're not seeing it translate into profits so directly. Are you seeing that as a reason to sell some of these stocks on an ongoing basis? Or do you think that's been basically what's behind the declines that we've seen so far?
I think that's what's behind the declines. That doesn't mean there isn't more of that to come. To repeat, though, people have big profits in these stocks, and they see other stocks beginning to move, and so to trim these to buy some of the others, I'm not convinced that rotation is over, which generally means for a sloppy market. As we've seen this rotation here in the month of July, the market's kind of moved sidewise as people are trying to figure all out. As you used the word earlier, it's confusing.
Yes, that's the story of the entire year, in the past couple of years. There is this issue. You said that you're not convinced that the rotation is over. The rotation has been curious because it's been marked by the companies that are most leveraged to the economic cycle at a time when we're talking about weakening, we're talking about cooling, we're talking about companies disappointing, and talking about consumers that are very price sensitive. How does that make sense?
It doesn't. In my view, I agree with your set of statements and trying to square the circle. Look, people have gotten very complacent, in my view. The economy is just fine. Earnings will be good. The Fed will get inflation down to 2. I'll hold my nose and buy stocks at 22 times forward, 26 times trailing earnings. That's a hard road for me to ride.
I have to say, Bob, I think everyone wants it both ways. When inflation was up and rates were climbing, we were talking about wider margins, better margins, because they had pricing power. Doesn't the opposite apply here, Bob? That when you start to see disinflation, even more disinflation in our future, it just means a loss of pricing power, which goes back to the point you're trying to make, which ultimately is, why buy cyclicals here? Isn't that the biggest headwind to that bet?
I think that's right. And the companies are waking up to the fact that they've moved prices up and they're starting to get resistance. particularly in the mid-income consumers. And that's new over the last bunch of weeks. And that can't be sustained without more weakening. So what do? They say we got to cut costs somewhere, and maybe we won't hire a worker or two. Maybe we'll let a worker or two go. And that's why you're starting to get some sloppiness in the employment data.
So we've got a decent idea of what you don't like, what you want to stay away from. Give us an idea of what you do like, what you're gravitating towards.
I come back to the common factors of earnings persistence, earnings predictability, and strong free cash flow. That's my defense, if you will, against the kinds of things we're talking about here. Those stocks have done fine as the market has moved up. I think they'll show their stuff even more if we get into a selling squall or some sort of sloppy sidewise action.
Is there a reason why you just are focusing on stocks? Is that just because that was the conversation, or are you just trying to avoid bonds? That stocks are both the risk factor as well as the havens factor, depending on where you go?
Only because that's the conversation. I would own some bonds here. Look, the economy is slowing. While second quarter earnings have been just fine, third and fourth quarter earnings estimate revisions have been to the downside. So the sloppiness is kicking in, and when that happens, you probably want to own a bond or two.
Which kind? Is this something that you're worried about in terms of longer term, or medium term is sort of the sweet spot, or do you think that right now it's time to lock things in?
I would own quality, meaning more treasuries than corporates and high yields. Look, corporate and high yield spreads are pretty tight, as you know. And if and as the economy weakens, the questions about how long will that weakness last probably causes these very tight spreads to widen some, and therefore the govies probably outperform.
Interesting. Bob, thank you, sir. Appreciate the update. It's good to see you. Bob Dole at Crossmark. You as well, sir. Big week ahead. Let's turn to the election. With fewer than 100 days until voters head to the polls, if re-elected, former President Donald Trump is widely expected to appoint a so-called Capitol Hill cabinet full of congressmen. A potential shortlist includes Republican Senator Bill Hagerty, who is being floated as a pick for Treasury Secretary. The Senator joins us right now. Senator, it's great to catch up with you, sir. We tried to do this last week, so this is our second attempt. I think this one's going to work.
Good to be back with you, Jonathan, Lisa. Thank you.
Let's start with foreign exchange if we can, sir. We caught up with the former president here at Bloomberg just a number of weeks ago. And in Bloomberg Business Week, he told us that he believes we have a bit of a currency problem in the United States of America. Senator, I would love your perspective on that, whether you agree with the former president on that issue, and what kind of policy tools you think the government has to address it.
We have a number of problems with the economy. I think the biggest one, however, and it's related, is inflation. And inflation is driving higher interest rates. Of course, that has a direct impact on our currency. But President Trump's policies will have an immediate impact to bring inflation down, because he's going to end this administration's war on fossil fuels, bring energy costs down, go back to a deregulatory construct, as he did in the prior administration, taking down regulatory and compliance barriers. All of these will have a lowering impact on cost here in America. It'll have a lower impact on inflation. Those will be directly beneficiary and basically help make the case then to bring rates down and therefore bring our currency into a different position.
Senator, there are two other proposals as well, which I'm sure you're familiar with. Much higher tariffs, a much tougher stance on immigration. I'm not going to sit here and say whether that's the right or wrong thing to do. I just want to talk about outcomes and consequences. Deutsche Bank, like others on Wall Street, Senator, as you know, have pointed out that tariffs and their associated stronger implications for the dollar are significantly more likely to be the dominant market outcome than policies to pursue a weaker dollar. Senator, my question to you would be, why wouldn't higher tariffs and a tougher stance on immigration ultimately just lead to stagflation?
Look, I'm fully aware of the concerns surrounding tariffs, but let me make this point. The United States of America has the lowest tariff barriers of any major economy in the world. The converse of that statement is that our major trading partners, do not have the similar tariffs. They have much higher tariffs. Therefore, we have a real lack of reciprocity. That's not fair. That's something that needs to be addressed. Many of these issues date back all the way to World War II. But there's come a time and a place to step up and address them. President Trump wants to see them addressed. We want to see more reciprocal and fair trading terms. The time has come to get that accomplished.
Senator, from a market perspective, people are struggling with these two goals, sort of national security, fairness on one hand, and on the other hand, the idea of the advantage of a weaker currency for trade purposes. Which takes preeminence?
Well, I think it's something that always has to be balanced, Lisa, and I think you'll see any administration do their best to do it. I think President Trump did an excellent job of that during his first administration. The playbook is laid out there. We were strong, we were tough with China. At the same time, we brought economic growth that was twice the rate of any other major economy at the same time here in America. So we can do both. We can walk and chew gum at the same time. I think that's the challenge. The most important thing, though, is that President Trump will come in and end these reckless policies domestically that have created inflation that has caused so many knock-on effects. Again, back to energy independence. We need to get there. Not only will it be important for lowering inflation here, but it'll be an important geostrategic tool as we become much stronger allies who are able to export our energy to places like Europe and Asia.
All right, let's go there. You've mentioned it a couple times, this idea of a war on fossil fuels, as well as the idea of not really achieving the goal of energy independence. We're pumping more oil in the United States. We're producing more oil than ever before, more than 13 million barrels a day. This is something unseen before in terms of production from any other nation. How can you say that it's a war on fossil fuels at a time where it is record production?
Lisa, it clearly is a war on fossil fuels because Joe Biden came in and took federal lands off the map immediately upon taking office. That's a quarter of our capacity right there. What you're not saying is that there was a trajectory that was much more rapid, much higher. We took ourselves off of that growth trajectory and we flattened it. We continued to produce, but demand is outstripping it. Think about the demand for electricity here in America. If you think about what we're going to need for artificial intelligence, the electrification of the grid, we've got to get back into the energy production business full blast. We have the technology to do it. This administration is done everything they can to slow that down. We need to get back on a rapid growth path. That'll put us on a trajectory to be not only stronger here domestically and lower inflation, but also stronger partners with our allies.
So, Senator, right now we're producing 13.3 million barrels of crude every single day. As Lisa pointed out, that's a record. It's more than anyone on the planet. How much crude do you think America should be and can be producing?
We should be producing more than anybody else in the world, as we are. We need to produce more LNG, and we need to become the strongest energy partner there is. You think about pipeline capacity and the difficulty of getting permits in this administration. You think about the difficulty of getting a refinery started here in America. All of these log jams and difficulties make it less possible for us, make it more difficult for us to be the best possible ally that we could. We need to expand it. We need to realize that this is a true source of competitive advantage for the United States of America. Let's exploit it.
Let's talk about who is an ally and who isn't an ally. There's lots of conversations about what's going to happen with trade policy and China. I think we've sort of exhausted that conversation many times over the last few weeks. Senator, I want to talk about Mexico. I want your view on Mexico. We saw from Elon Musk of Tesla that he's holding back investment decisions in the country because he thinks there might be a change in the next year that makes it difficult to produce automobiles over in Mexico. We've heard similar thoughts from auto manufacturers elsewhere worldwide. What is happening in Mexico, and what kind of changes would you like to see?
Well, in 2026, the USMCA is up for renegotiation. I think one of the greatest concerns is the fact that Chinese EV makers are looking to end-run the end-run tariffs and use the USMCA and Mexico market in particular as a means to get into the U.S. market, and they're using their subsidized product destroy the U.S. market. That's going to have to take a very solid look. I think also with respect to Mexico itself, we've seen some very concerning behavior there. The prior administration there under AMLO actually nationalizing American companies' assets. We've got to address that. I intend to speak with the new administration there very soon about what we can do to make certain we have much better and much stronger relationship there with Mexico in fairer terms.
Senator, the last time we tried to talk, you were at a Bitcoin conference, and this was our cryptocurrency conference, and that was where the former President Trump was speaking and fundraising, and we've been asking this question on the show. Why Bitcoin? Why now? Why crypto assets? What's sort of the motivation to really embrace a network of crypto assets and become the preeminent network on the planet? From a Republican sort of stance, is this something that is concrete, and why?
Lisa, I think this is something that has evolved over time. I first began looking into crypto in the previous administration in 2018. That was my first engagement. I initially started at a point of skepticism, as I think many of my colleagues do. But when I began to understand the underlying technology and realizing the potential for dramatic productivity gains, what I thought to myself is we need to make certain that it happens here in America. The last thing we want is to see what happened with the semiconductor industry, where it got pushed offshore and weakened us from a geopolitical standpoint. We need to see this innovation happening here. I've been in many conversations with President Trump. His thinking is likewise involved, and he's embracing the fact that this has tremendous potential for America. We want it to evolve here. We want to create the ecosystem for it to thrive here. And the last thing we need to do is push it offshore. However, the current administration has done everything they can to attack this industry, to push it offshore, again, to use the SEC, the CFTC, every tool at their disposal to come in and attack this industry and refuse to provide it with any type of regulatory framework. President Trump made the statement at the Bitcoin conference that one of the first things he'll do is change out the administration's leadership. Gary Gensler, he said, will be fired. That brought people to their feet in applause. He's going to end Operation Choke Point that's been taking place in the crypto industry here in America, and he's going to try to create the environment here where the industry can thrive, and we'll see the next wave of innovation happening right here in America.
Senator, we've got to dance around the issue about your future, so this is how I frame it. I've got 20 seconds left on the clock. Your favorite city to live in, Nashville, Tokyo,
Absolutely.
or Washington, D.C.? Which one?
No, it has to be Nashville, Tennessee. And if you'd been there at the crypto conference, you'd have seen the energy there. It is absolutely wonderful what's happening broadly across my state. That's why so many people are moving there.
Senator, thank you, sir. Beyond big tech, investors also awaiting the Fed decision. The FOMC's two-day meeting kicking off today. Fed Chair Jay Powell widely expected to give a soft signal for a September rate cut. To discuss, Tiffany Wilding of PIMCO joins us alongside Steve Ricchiuto of Mizuho. To the both of you, thanks for being with us. Tiffany, I want to cross over to you first and get your thoughts on what we can expect tomorrow afternoon, what kind of changes you're looking for in the statement and what you expect the chairman will emphasize in the news conference.
Well, I think he's going to say that they are more confident that inflation is starting to move back towards their goal after progress had stalled in the first half of this year. Of course, the fact that shelter inflation has shown more progress in the last few inflation prints is going to help in that. But I don't think that they're going to, I don't think they're going to be in a huge rush. We think they are going to signal a September cut, but the economy appears to be doing okay here. So, I think, in terms of market pricing, the Fed is very focused on, I think, cutting maybe at a once a quarter pace, taking it slow at least at first, unless the economy appears to be rolling over more heavily. And it doesn't. So, I think he could actually come across as being a bit more balanced, although we do think they are going to cut in September relative to what markets are pricing.
We don't get an update to their assumptions, their forecasts this time around. We'll get them in September, I believe. Tiffany, I'm looking at their current forecast for unemployment. They've got that for 2024 at 4%. That's below where we are right now. You mentioned maybe them going in September and cutting once every quarter. What would your assumptions be in the labour market for unemployment, given that's your call for interest rates?
Yeah, so we think unemployment probably ends around where it is now, 4.2, maybe a little bit higher. The labor markets are normalizing, but we think the important fact here is that you haven't seen a lot of, actual layoffs. If you just look at the level of employment, has not really declined. Those are usually the hallmarks of recession. So, we think we're seeing a labor market here, which is easing, certainly. We've had a lot of supply, more supply coming in the labor market as a result of immigration, and that appears to be the story to us, and I think that still allows them, to kind of, cut and do it at a pace, that isn't hurried like we see in a recession.
Steve Ricchutto, I know that you're sympathetic to the view that they don't have to rush. You've been talking about the potential for no cuts being actually okay for 2024, given the fact that there is plenty of momentum under the hood. Do you still feel that way? That, frankly, all this talk about even cutting rates tomorrow is premature, and that you think they should really hold off and be more patient than many people think?
To answer your question real specifically, they're winning. They're winning without having done anything, which is the most interesting aspect of this. The promise of rate cuts has led to financial market conditions which are much more accommodative than the federal funds rate implies. So therefore, there's a question as to whether or not they actually have to adjust the federal funds rate. The reality is they run the risk, if they do adjust the federal funds rate, of people over-anticipating what they will do. I think they would be very happy over the long term with a gradual reduction reduction in rates, but you've got a Federal Reserve that is dominated by political economists who are very, very much sympathetic with a much more aggressive monetary policy reduction, and therefore the market reads that and is likely to say, okay, once they cut, it's not going to be every other meeting, it's not going to be once a quarter, it's going to be every meeting. And that's why when you look at the forward structure of rates, for example, SOFR going out over the next year or so is telling you that the market's assuming we're going to get to a 2% Fed funds rate, where I think a lot of economists would be sitting there saying, well, maybe we get to 3 or maybe we get to 3.5. The reality is the market's priced in much more, which is why financial markets are so accommodative, which is why they're winning without doing anything.
Steve, you said political economists and that they're in favor of a much more aggressive rate-cutting path. Can you tease that out? Because some people might hear that and say, okay, they want to cut rates, that they support an administration or another. Is what you're saying a little bit different?
Yeah, I mean, you've got people here who are policy wonks. They want to play with the levers of monetary policy. They want the idea, the administration likes to play with the levers of fiscal policy. This is a throwback to the 1950s, 1960s, where we had a group of economists that came in that thought they could use, monetary and fiscal policy to craft an economy more suiting to their liking. And we're trying to do exactly the same thing here again. Now, the results of what happened in the 60s and 70s was we wound up with a stagflation environment, which we're not anticipating here because we had a world of excess demand there. We have a world of excess supply here. But the reality is you could wind up with a higher rate of inflation than the market is discounting. I think the biggest risk for the market is not at the front end of the curve. It's at the long end of the curve, because yields at the long end of the curve are not taking into consideration the risk that what these policymakers are doing runs the risk of creating an embedded higher inflation rate than is currently priced into the long end of the curve.
Steve, are you suggesting there's more chance that 10s trade in the 5s next year than they trade in the 3s?
I think that's exactly the right scenario to think about. That is the risk-reward trade, yes.
Tiffany, you're at the bond house. What are you and the team doing with regard to that? How are you thinking about the challenges to the long end of the curve in 2025?
Yeah, I mean, we certainly think that over the longer term, markets can price in more, just more term premium, as a result of the outlook for the U.S. federal government deficits and debt. Clearly this is, we're on an unsustainable trajectory. That trajectory is the result of, Social Security, liabilities in the future, and these non-discretionary programs, the U.S., those will have to be corrected at some point. Obviously, the big loser coming out of the pandemic was the government balance sheet with additional debt. And at some point we agree that the markets will need to price in some more term premium for that. But at the end of the day, and you could get a steeper interest rate curve, but at the end of the day, we think that government policymakers, maybe not this administration or the next, eventually they will do the right thing, and we will, get some course correction. And we think the markets are currently giving the U.S., that longer-term fiscal credibility. So, I mean, ultimately, I think it's nuanced discussion. We think the curve can steepen, so more term premium can get priced, but we aren't expecting, some messy volatility to result from this.
Tiffany, what do you make of Steve's argument that these officials on the Fed are political economists who harken back to sort of some of the philosophies of the 1950s and 1960s of fine-tuning everything? So they're going to be more prone to trying to support a market and being a put, essentially, the way that they're being treated in markets right now as sort of, either way, it's going to be okay because they can come to the rescue. Do you kind of find sympathy with that view?
Well, I mean, I think that now that inflation has moderated quite a bit, and now that people are more confident that you are still going to get some additional moderation, it could be slow, probably will be bumpy, might not get core PC inflation all the way back to 2, but could live with it in a 2-point-something zone. The Federal Reserve officials, as they should, are going to start to focus more on, the labor market side of the mandate. And, the view view over the last, several years, I would say, and even in the long-term strategy review that was completed several years ago, the view was that if you let the labor market run a little bit hot, it's okay for the economy. It's actually good. You have people coming back to the labor market. You have underserved communities, that really start to benefit from that. And I think that's certainly the kind of policy views that people have. And as a result of that, they will be quick to start to drop interest rates, I think, if you do see a labor market that's loosening or rolling over more than they expect.
Steve, I want to just finish up with you because there's this question about what the consumer is doing based on some of the corporate guidance that we've been getting. It's been sort of highlighting the pricing, the lack of pricing power at a lot of different companies. And pointing to this question, as John's been asking repeatedly, and rightly so over the past 6 months, is it weakening or weak, cooling or cool? Are you changing your view on whether this is actually truly a less perhaps heated economy than you thought, say, a month ago?
No, I think the economy is still going to see an inflation rate at the end of the year that's much higher than the Federal Reserve's target. I think the hope that the currency continues to provide the ability for global goods deflation to dominate or to have an impact on the favorable impact on the domestic inflation story is a risk. Foreign central bank policy decisions can have an important impact on the currency. It's not just the U.S., and the currency has been one of the critical components here. If the dollar were to take a turn to the downside, and you were to take, for example, your DXY measure, and you were to head it back towards 100 from the 104, 105 area it's been trading in, you could have a significant impact on goods inflation. And if you had a significant rebound in goods inflation, you would have a significant bounce in inflation. And therefore, it's not just the monetary policy decisions here, it's the monetary policy decisions overseas. And that's why you shouldn't rely on that component to be the component that drives your inflation story, especially when you want to keep a labor market hot. This concept of a hot labor market gets to the question of, well, what is a hot labor market? The natural rate of unemployment had always been seen to be 4.5%. Now suddenly we've lowered the target for where the unemployment rate should be by the end of the year to 4%. That's a very significant downward adjustment in the unemployment rate. So yes, the Federal Reserve lowered the threshold to make it look as if the labor market is accommodative or becoming more available, or the slack is developing in the labor market more quickly than is actually taking place. And this is a critical component. You look at the claims numbers, you look at the continuing claims numbers, you look at the number of job layoffs, people are not getting fired, and it's harder and harder to find skilled workers. Wage pressures aren't coming off the boil. It has been really an environment in here where global goods deflation has been pulling down the headline inflation, just like global goods inflation moved a lot of it up to the upside during the COVID environment. It's now reversed that, but by the same token, the service component is not coming down, and the service component is the dominant component within the U.S. inflation rate because we are much more of a service economy than we are a goods economy.
Hey, Steve, Tiffany, big week ahead. Thanks for giving us some time this morning. Steve Ricchiuto there of Mizuho, Tiffany Wilding of PIMCO, two of the very best in the world of economics.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.